Okay, hello everybody and welcome to our webinar on shareholder agreements and succession planning. My name is Scott Garner. I'm Head of Business Development at Rix Kay. I'm going to give a quick introduction to the speakers before we move on to them and let you know what we'll be covering today. So the webinar will be a combination of speakers from both Rix Kay and MHA Carpenter Box. We're pleased to have them on the call today. A brief introduction to both the firms. Rix Kay is a firm of solicitors, full service law firm with offices based predominantly around Kent and Sussex. Our main centres are in Brighton and Hove, in Sevenoaks and in Ashford, and our regional centre in East Sussex is in Uckfield. Moving on to MHA Carpenter Box, they are an award-winning firm of chartered accountants, tax and business advisors. They're prominent in the southeast as well, and their offices are based in Gatwick, Worthing, Brighton and Hove and Chichester. I'm going to let the individual speakers do their own introductions, but just a quick overview of what we're going to cover today. So first of all, my colleague Catherine Paisley will be touching on shareholder agreements. I'm then going to hand over to Bruce, who will take you through business property relief and succession planning. And then David Crowther, tax partner from MHA Carpenter Box, will take you through some tax structures for businesses. So without further ado, I'm going to hand over to my colleague, Catherine.
Thank you very much, Scott. Hello, everybody. Thank you for joining us. As Scott mentioned, my name's Catherine Paisley, and I'm the head of the corporate and commercial team at Rix Kay. Next slide, please, Scott. So what I'm planning to do for the next 15 minutes or so is to take you through shareholders agreements, give you a brief overview of what they're all about, have a think about how they interact with the Articles of Association and the company's constitution, think about how succession planning might be able to feature in your shareholders agreements, and then finish off by just having a think about why it's really worth reviewing your shareholders agreement now. Thanks, Scott. So shareholders agreements, what are they? They pretty much do what it says on the tin. They're agreements between shareholders. The parties to shareholders agreements can be all of the shareholders in a company or just some of them. If you've got an investor in your company, then it's quite often the investor who drives the terms of the shareholders agreement because, of course, they hold the purse strings. You can quite often have the company as a party to a shareholders agreement, and when I'm drafting, I would usually recommend that's the case because then you can tie the directors in effectively as well to the agreement. You've got to be a little bit careful about fettering discretion in that circumstance, and that's a company law technicality really, which is where you can't prevent a company from doing certain things. But that's a technicality for the drafter to think about. When you're looking at a shareholders agreement, don't forget the distinction between shareholders and directors. It's quite often the case that in smaller companies in particular, the shareholders who own the company are the same people as the directors who run the company. But you do wear separate legal hats, you do have separate legal functions, and you need to just keep that distinction in mind. Thank you, Scott. So what does a shareholders agreement achieve? A number of things really, but in essence what it allows the parties to do is to control how the business is run beyond the day-to-day management that's reserved to the directors. It sets out how the shareholders are expected to behave as against each other and as against the company. Thank you, Scott. It can look at a number of different things. So the list I've set out here isn't exhaustive by any stretch of the imagination, but it's just a number of things that we can look at. So for example, you can think about the appointment of directors. Do certain shareholders have rights to appoint a certain number of directors? You might, for example, if you have a 75% shareholder, they might want enhanced rights to appoint more directors than perhaps the 25% shareholder. Alternatively, if you are the 25% shareholder, you might want the ability to appoint a director in order to protect yourself against that majority shareholder. Because don't forget that the basic position at law is that directors can be appointed by ordinary resolution of the shareholders and usually by the directors making a resolution by themselves as well. So your shareholders agreement might contain enhanced rights over and above those. You can think about dividend policies. Do you want perhaps different dividend policies for different share classes? Quite an important thing that appears in many shareholders agreements are restrictions on the shareholders and what they can do when they leave the company. So again, the basic position is that there are very few restrictions on shareholders when they leave, within reason, as long as people are abiding by directors' duties and not abusing confidentiality, that sort of thing. A shareholder could leave a company and effectively set up in competition just down the road. So you might want to write into your shareholders agreement restrictions on what shareholders can do. So perhaps they can't set up business in competition within a certain geographic area. They can't poach your best employees, that sort of thing. Another important one to look at in a shareholders agreement are quite often deadlock provisions. So this is the situation where, and it's usually the case in 50-50 companies, but they're also quite valid where you've got shareholdings of different levels. And you want to think about a mechanism to deal with the situation where you simply can't agree on how to proceed on a certain matter. And you can have different ways of dealing with that, from perhaps a cooling off period, moving into perhaps rights of one shareholder to buy another out, or possibly both shareholders putting offers on the table and the bigger offer wins, right up to the nuclear option of just saying you simply have no way of getting through this deadlock and maybe winding up the company. You can look at provisions for the transfer of shares, whether those are permitted transfers or compulsory transfers, and we'll look at those in a bit more detail in a minute. Or maybe further funding. Are you expecting, for example, that all further funding should come from the shareholders, or that you should always look to a third party for further finance, that sort of thing? Thanks, Scott. So how does the shareholders agreement interact and compare with the Articles of Association? The Articles of Association are generally called the constitution of the company nowadays. In older companies, you've also got the Memorandum of Association to think about, but nowadays it's generally just the Articles of Association. They're a publicly filed document and they bind all members of the company. So if you are a shareholder in the company, you are automatically bound by the Articles of Association. They have to be filed at Companies House. Against that, a shareholders agreement is generally a private document. It only binds the parties to it. You don't, as I said before, you don't have to have all shareholders being a party to a shareholders agreement, but you can build in a mechanism to a shareholders agreement that obliges anyone who becomes a shareholder, whether that's by transfer of shares or by the issue of new shares, to be bound by the same shareholders agreement by signing up to it by way of a deed of adherence. The shareholders agreement is generally, sorry Scott, just if we can go back, the shareholders agreement is generally private, so that might be the home for things that you don't want to be in the publicly filed Articles of Association, things that you'd rather keep to yourselves. Thank you, Scott. There are differences as well in terms of breach of those two documents. If you breach a term of the Articles of Association, you can generally consider that your action will be considered to be void. That means it just never happened. Whereas if you breach the shareholders agreement, then the people who are party to that agreement again with you will have a claim against you for breach of contract. It's dealt with slightly differently. Don't forget as well, when you're thinking about shareholders agreement and Articles of Association, that there are other documents that regulate things that the companies can do. For example, the directors' service agreements. Thank you, Scott. So how can you start thinking about succession planning in your shareholders agreement? And this, I think, is where we come back to the provisions relating to transfers of shares. Again, the general position is that there are very few restrictions on whether shares can be transferred or not. There's quite a lot of freedom on shareholders as to how they transfer their shares. So you might want to put in place some sort of framework, maybe some restrictions on when people can transfer shares and what they have to do when they're transferring. You can think about situations in which you're going to permit share transfers without the requirement for shareholder consent, maybe. So perhaps to family members or to family trust in the event of tax planning. Or if you're thinking about a corporate shareholder, maybe to members of the same group of companies as that particular corporate shareholder. Then, of course, you have to think about the situation if there's a relationship breakdown between the transferor and the transferee in that situation. So if, for example, shareholder A has transferred all of its shares to Mr. A or Mrs. A, and then there's a divorce, does Mr. A or Mrs. A have to return shares to shareholder A? I think usually the answer to that is yes, but that's something to think about. Thank you, Scott. Then there's the other side to that particular coin of when you might have a situation in which you're going to oblige people to transfer shares. So has something so bad happened that you don't think it's right that people should keep their shares anymore? The sort of things that might give rise to compulsory transfer provisions could be personal bankruptcy, perhaps, or corporate insolvency. If one of your shareholders might also be an employee and that person leaves his or her employment, and then you can add into that a thought process about whether that person's a good leaver or a bad leaver, which dictates the value that attaches to those shares at the time of departure. Perhaps in the instance of death or mental incapacity, and we'll look at that in a little bit more detail in a minute. or maybe in situations of breach of the agreement. So if there are repeated small breaches, or if there's a material breach of the agreement, you might say that that's bad enough to require transfer of shares. Then, of course, you've got the difficulty of proving the breach. And you can also just use your shareholders agreement as a way of planning a planned exit. So thinking about the terms, the framework for your departure in due course. Thank you, Scott. So I mentioned a little while ago that you could put in place provisions for death or mental incapacity of a shareholder. And I'm not going to look at this in very much detail, but what you do find quite often working in conjunction with shareholders agreements are cross-option agreements linked to life policies. And the essence of these is that they give shareholders the option to purchase the shares of any shareholder who dies while a shareholder. Because they're linked to life policies, the life policies will put the remaining shareholders in funds to pay out the estate of the deceased shareholder for those shares, which means the estate and then thereby the beneficiaries are recompensed for the value of the shares. But the beneficiaries aren't obliged to become part of the company because they no longer own the shares, they've got the cash instead. And the beauty for the company itself, of course, is that it's not obliged to let the beneficiaries become part of the company. Thank you. Another thing that you could think about in your shareholders agreement is maybe the possibility of a company buyback in the event of a shareholder death or exit. It's always worth bearing in mind that company buybacks, so this is where the company actually buys the shares back from a shareholder, are subject to very, very strict laws under the Companies Act, and therefore they've got to be handled with very great care. Thank you, Scott. So something else to think about, and you'll find in most shareholder agreements a list of reserved matters. What reserved matters are effectively things that give shareholders a right of veto. And the reason, or one of the reasons I'm talking about this now, they do feature in many, many shareholders agreements in any event, but actually somebody who was joining our webinar this morning raised the question about what he might do to protect his interests if he wanted to make an exit from the company and leave it to the younger generation to deal with. And this is a way that can perhaps be managed by somebody perhaps retaining a small shareholding, but effectively keeping a right of veto over certain very important decisions. So the reserve matters are things that require shareholder consent, and you set those out in your shareholders agreement. So the directors are not allowed to undertake this action without seeking the consent of the shareholders. And you can set the threshold for where you want that consent level to be. Could it be 60% of the shareholders or 75%, or perhaps the consent of a particular shareholder needs to be there? What I would caution is that you have to be careful not to make your list so long that you effectively stop the directors from being able to run the business in the ordinary course. So you're really thinking about things that are outside of the ordinary course of business that would matter in the life of the business. So for example, maybe taking a new lease on a property, or capital expenditure over a certain amount, or perhaps appointing a new CEO on a particularly high salary, that sort of thing. Thank you, Scott. So why should you review your shareholders agreement now? And when I'm talking about now, we really are talking about now. So in this post-COVID, mid-COVID environment, what we're finding from our clients and from the market generally is that shareholders are in some cases, particularly in the older generation, just a little bit fed up. They're going through this slight recessionary period caused by COVID, having been through recession before, certainly once, maybe twice, and they don't want to have to do it again. But maybe this isn't the right time for them to sell. So we are noticing, of course, that the banks aren't available to lend monies to buyers at the moment because they're busy doing other things. So maybe this isn't the right environment to sell. So perhaps instead of thinking about a sale right now, you can do some housekeeping and just set the groundwork for an eventual exit when the time is right. So maybe in 3 to 5 years' time. Thank you, Scott. You can think about using your shareholders agreement to set your different exit goals, to think about whether maybe different shareholders want to plan an exit for a different time. You should be flexible and fluid in your drafting. The ideal position to achieve with a shareholders agreement is that it reflects the way in which you act together and which you'd like to act together, rather than you having to adapt your practices to suit a more rigid document. And don't forget that although you will need the consent of all parties to it, in order to change the terms of a shareholders agreement, it should be up for review every so often. Perhaps every 5 years or so, when you look at your 5-year business plan, it's worth just pulling the shareholders agreement out and checking whether it still is fit for purpose, whether it still suits the needs of the business. The other thing to bear in mind, of course, is that it's not all about reviewing a shareholders agreement. If you've got more than one shareholder in your company and you don't have a shareholders agreement in place yet, we do strongly recommend that you think about it as an option. Thank you, Scott. So just a few thoughts to take away before I hand you over to my colleague Bruce. Shareholders agreements give shareholders the flexibility to decide how they want to control the business without it needing to be a public document. It should be a fluid document and up for review every so often so that it's able to change with the needs of the business. And crucially, what shareholders agreements do is they prevent arguments or distress at the time of a shareholder death or exit, or in the event of a dispute, because the parties know when that event arises that they've already set out a framework for dealing with it in their shareholders agreement. Thank you. I shall now hand you over to my colleague Bruce, who's going to talk to you about business property relief and inheritance tax planning. Thank you for listening.
Thank you very much, Catherine. Hello there, everybody. For those who don't know me, my name is Bruce Clark. I'm a partner in Rix Kay's Wills and Estate Planning team. And as Catherine said today, I'm going to have a look at business property relief, and in particular, what it is, how it applies to those with interests in businesses, and the conditions that need to be satisfied to claim the relief, as well as some ways that we can use it and take advantage of it as a tax planning tool. At the end, I'm going to quickly touch on my thoughts as well for the future of business property relief, given the current economic climate. It's going to be a bit of a whistle-stop tour, I'm afraid, as there's quite a lot to cover. Business property relief in itself is quite a complicated area. And whilst I'm only really going to touch on the basic principles, do feel free to drop me an email or get in touch later on, and we can have a chat about more specifics if you'd like to. So what is business property relief? I'm going to call business property relief BPR going forward, just to make it a bit more manageable. It is a bit of a mouthful. Essentially, BPR reduces the transfer of value for inheritance tax purposes. So in other words, if a person makes a transfer value of, say, £1 million, but the asset being transferred qualifies for BPR, the relief reduces the value transferred by the 50% or 100%. So as you can see, it can be quite a valuable relief. BPR applies to transfers of value both on death and during one's lifetime. So for example, a lifetime gift of business property into a trust will result in a lower amount of inheritance tax being payable, possibly even being reduced to zero overall. And likewise, if a person leaves assets qualifying for BPR as part of their estate, the inheritance tax attributable to those assets could potentially be brought down to zero. So briefly, what conditions do we need to satisfy to claim the relief? BPR is basically available on property that is known as relevant business property. The definition of that is covered by the legislation and includes a business, a share in a partnership, shares in unquoted trading companies, and can also include shares in a quoted trading company. But before everyone gets too excited about thinking that their shares in the likes of Sainsbury's and Co are going to qualify, a quoted trading company needs to be a controlling interest in the quoted trading company, i.e. more than 50% of the shareholding. So that would be quite a lot of shares in Sainsbury's to achieve that. It also applies to land, buildings, plant, and machinery, which is owned by somebody and used in their partnership or company that person controls. And those assets can also qualify for BPR. So therefore, if someone owns, say, 51% or more of shares in a quoted trading company, not only will he get BPR on the transfer of those shares, but the land, buildings, plants, machinery, etc., that he owns that's used by that company will also get BPR as well. Thank you very much, Scott. So, as I mentioned earlier, BPR is given at the rate of either 100% or 50%. Generally, transfers of businesses or shares in unquoted trading companies will qualify for BPR at 100%, which essentially means that the transfer is tax-free. transfer of shares from a holding a trading company, quoted trading company, so it will qualify 50% relief, and the 50% rate also applies to the transfer of land, buildings, plants, machinery, etc. that's owned by a person used in their partnership, for example. So potentially some quite significant savings to be had. There are other points that we would need to consider to make sure that the assets, or using shares as an example, making sure the shares qualify for BPR. The shares must be shares in a trading company. So shares in an investment company or property dealing companies, generally speaking, won't qualify for BPR. The other point to remember is that for the purposes of BPR, the term quoted means that the company has a full listing on a recognised stock exchange. Interestingly, shares on the AIM market, the alternative investment market, are actually treated as unlisted for the purposes of BPR. And there are a number of investment managers that have over recent years started focusing on building portfolios containing those AIM shares so that BPR is available on death. The other point to remember is that for BPR to apply, the person owning the asset, the shares in this instance, must have owned those shares for at least 2 years before the transfer of value. If that minimum ownership period hasn't been satisfied, BPR won't be available. There are some exceptions to that general rule. For example, if somebody sells old business property and replaces it with new business property, or if there's been a transfer between spouses on death, but using the 2-year rule is a good starter for 10. And finally, the other important thing, particularly following on from something Catherine mentioned earlier about shareholders agreements and agreements for purchase of shares in the event of death, for example, is that if there is a binding contract for sale over the asset that would get BPR at the day that there's a transfer of value, the BPR isn't allowed. So, for example, those shareholders agreements, it's very important that any agreement for the purchase or sale of shares in the event of death, it has to be an option, not a binding contract for sale at the time. But again, that goes back to the drafting, but something just to bear in mind, as there have over the years been a number of cases where that restriction has been explored in quite some depth. So having very quickly gone through the basics of BPR, the next thing I would like to touch on is how we have and can use it when it comes to inheritance tax planning. And one of the more popular things that we discuss with clients is the use of a trust to receive assets that qualify for BPR. Whether that trust is created during the client's lifetime or as part of their testamentary estate planning very much depends on the individual circumstances. And of course, the other thing we have to remember is that inheritance tax planning needs to be looked at as part of a much wider estate planning exercise, and in the round, we don't just want to focus on the tax planning element. And often the question that really comes out of that exercise is whether or not our clients want to bank the availability of BPR at that point. So for example, where we have somebody owning assets that qualify for BPR and is survived by their spouse or civil partner, if the assets are left outright to their spouse, the gift will be exempt from inheritance tax in any event because of the spouse exemption. So therefore, we have to ask the question of whether it's better in terms of estate planning to make use of the spouse exemption or BPR. So in other words, the decision really turns on whose hands the assets end up in, rather than being driven by the tax savings. Ultimately, in those instances, it doesn't matter from the tax side of things which relief is given, but there may be some advantages longer term to ensuring that those assets don't become part of the surviving spouse's estate, when we're looking at things like care fees, the potential loss of the relief in the future, for example. The other point to consider is that depending on the nature of the business and the shareholdings, it may be that the surviving spouse doesn't want to continue to effectively run the business, and have a say in what goes on in those circumstances. The business may end up being sold, in which case proceeds of sale themselves don't attract the relief from IHT in the surviving spouse's estate. The other thing to remember, and something I'll come on to in a little bit more detail later on, is that the relief could be withdrawn. So although we might try and might say, actually, let's just use the spouse exemption on the first death, it may be that things change as time goes on, and in the hands of the surviving spouse, the relief isn't available. So really, the alternative to leaving assets to a surviving spouse is for those assets to be left into discretionary trusts where the assets will qualify for BPR on going into the trust, and if those assets are sold in the future, those proceeds of sale will be held outside of the surviving spouse's estate. The other thing really to remember there is that just because the assets are put into a trust doesn't necessarily mean that the surviving spouse can't benefit from that trust. And in fact, it's quite often the case that the surviving spouse is actually a beneficiary. At the same time, we would normally include children and remoter issue, grandchildren, great-grandchildren, and so on, as beneficiaries as well, meaning that there are potentially beneficiaries brought into play now than otherwise would be the case, while still mitigating or potentially even eliminating the tax bill. The other thing to remember with trusts, of course, is that if they go into a trust on the first death or during lifetime, on the death of the surviving spouse, they don't form part of that surviving spouse's estate, and so aren't included for inheritance tax purposes. Effectively, we don't get caught twice for tax. There's also the possibility that that surviving spouse could turn some of their own assets that wouldn't otherwise qualify for BPR into assets that would. So, for example, the surviving spouse could purchase the business assets from the trustees, effectively turning their cash, which would of course be chargeable to inheritance tax, into assets that would potentially qualify for BPR. And then we would look at the trust and whether the trust can look at distributing that cash relatively quickly, or how it can be used, depending on the circumstances, either to further the estate planning element or the inheritance tax saving element. But as always with these sort of things, we need to look at things in the rounds, because it's very unlikely that we're going to be able to do something without other taxes coming into play. So, you know, as I said earlier, we need to look at this in the rounds, not just purely from the point of view of trying to save inheritance tax. I mentioned earlier, thank you, Scott. I mentioned earlier, I'd touch very briefly on the future of BPR. To be honest, what is going to happen is a bit of a bit of guesswork. One thing that is very clear at the moment is that at some point, the government is going to have to try and raise funds to top up the Treasury's coffers to fill the void that's been left from them having to spend quite a considerable sum of money in recent times, given current events. There have been a number of views expressed in the media and you know, professional media and more wide mainstream media, that perhaps inheritance tax and the like aren't going to be targeted quite as much as we think. I agree that inheritance tax, capital gains tax, those sort of taxes don't necessarily produce the amount of money for the Treasury that the likes of income tax, VAT, corporation tax does. But the thing with inheritance tax is it is often seen as a tax on the wealthy, and it may be that changes here are the quid pro quo for the government in changes elsewhere that affect the wider population. Politically, they're probably easier to get through. I don't think any change is going to be brought in en masse. I think we're going to see these changes drip fed through, but because we don't know what they are or what they are likely to be, it's a case of sort of making the most of what we know at the moment. There have been a lot of, well, there have been a fair few reports in recent years on inheritance tax and capital gains tax. BPR featured quite prominently in those. And there have been a number of suggestions for the way it could be reformed. Some suggestions actually work to the taxpayer's favour. But then when they're drilled down to in a bit more detail, they do have knock-on effects elsewhere for other taxes. For example, CGT and IHT, so inheritance tax, do often go quite hand in hand. So really, at the moment, I'm afraid it's a bit of guesswork, anyone's guess really, as to what will happen in the future. However, we know what we are dealing with at the moment, particularly with BPR. And whilst it's unlikely that anything introduced will be retrospective, it's certainly better to act now and use the reliefs available to us as they stand, and we know how they work, rather than risk waiting to see what happens. So on that very cheery note, I'm sorry it's been a bit of a quick tour through it, and as I said, I'm very happy to have a chat about more specifics in detail at a later date. But I'll now hand over to David, who's going to look at succession planning from a slightly different angle and some of the things he's been doing with his clients in recent times.
Thank you, Bruce. Good morning, everybody. It's David Crowther here from Carpenter Box. I'm going to be talking to you this morning principally about structure and whether changes to capital gains tax mean that you might need to consider a new structure of ownership for your business. There's been a lot of changes to capital gains tax previously, and there's some changes to capital gains tax that may be taking place in 2021, and I think that those changes give us cause to question some of the conventions around the structure of ownership that have existed for some time. One of those conventions being direct personal ownership. So prior to March of 2020, if you own shares in a trading company, for example, you might, if you were to sell those shares, benefit from entrepreneurs relief, and that was, you know, the first 10 million of capital gains at 10%. Now, what's happened since that time is that relief has reduced down from 10 million to 1 million. We also expect, or we don't know, that capital gains tax may be increased at the next budget, or even the £1 million entrepreneurs relief threshold will be withdrawn entirely. So if those things transpire, then I think it does cause us to question some of the conventions that existed for some time. And so, you know, the purpose of this morning really is to highlight that point and to give you some examples of the more sort of structures that we might see more of going forward. Speaking to the Rix Kay guys earlier this week as well on some of the COVID related planning that we've been doing, not related to structure. We said that we'll cover just a few points at the end on some COVID related items that you might want to consider. So 1 and 2 is just highlighting some new structures that you might want to consider going forward. And as I said at the end, we've got our what we're calling here our COVID related tips. So there's an important concept that we need to be aware of, particularly if capital gains tax rates generally are going to increase. And that is the concept of the substantial shareholding exemption. SSE, as it's known, I'll just perhaps describe that as, you know, the corporate version of entrepreneurs relief, or business asset disposal relief as it's now known. But rather than a 10% rate of tax, we have a 0% rate of tax if we meet the conditions. But if you're a business that previously would have qualified for entrepreneurs relief, then there's every prospect that you might qualify for the substantial shareholding exemption. So, for example, if you had not a trading company owned directly by you, but if you own the shares via a holding company, if the holding company was to sell its shares and it owned more than 10% of the shares for at least 12 out of the last 24 months, then substantial shareholding exemption may well apply. And in that case, the corporation tax rate would be 0%. Now, of course, that isn't a like-for-like comparison as far as tax is concerned, because, of course, the funds are then locked away in the holding company. So we have to then think about what happens next in relation to those funds. So if you wanted to go away and spend all of that money on luxury items, it's not a structure that's necessarily going to work for you. But what it does mean is that if you have a holding company, that it could be that you then have the choice when you come to sell the business of, you know, might you sell the holding company, or might holding company sell the trading company? So You can see on the left-hand side here, we have husband and wife business, for example, that rather than them owning the trading company directly, they might insert between themselves and the trading company a new holding company, giving them potentially the opportunity of selling holdings or for holdings to sell trading. In my experience, it's not common, it's not a common problem for a buyer to buy holdings from the husband and wife in this particular example. If we look on the right hand side, the example to the right, might you see a structure that looks like this going forward? So for example, husband and wife own half of the company directly, and then the other half through a holding company. Now, it's not very easily at the outset of when the business are formed to know that, in this example, that 4 million is going to be the eventual proceeds. So you might not be able to structure it perfectly as it is in that particular diagram. But if you were able to do that, might the individuals sell and get £2 million at 10% and actually have £2 million into holding company at 0%. Now, of course, what they will then have in H is an investment company, and it's the investment company that can invest those funds going forward. Certainly for clients who are selling their business, one of the questions that we're going to be asking is, well, what are we going to do with the money? Because very often that money is going to be reinvested in some way. And that might be reinvested in a new business, it might be reinvested in the stock market or something else. But it's not tax inefficient as it stands at the moment for whatever that reinvestment is to take place in a new holding company. So perhaps we might see structures on the left-hand side or the right-hand side more going forward. Now that was obviously a family company example. Might we have an example, perhaps where the shareholders aren't related, connected with one another particularly, that one or more of the shareholders owns their shares not directly but via their own holding company. We've got an example there of 4 individuals, each of them owning the shares via their own holding company. There's no reason in principle why you couldn't have some owning directly and some owning via their own company. Of course, we've heard a bit about shareholder agreements and the like, that if we're going to adopt these new structures, we need to be very clear on what changes need to be made to those sorts of documents to make sure that our constitution is it still operates in the way that we would like it to. But in this particular scenario, if each holding company has got more than 10% of a trading company, then it's possible that, again, the SSE may well apply. So in a family company environment, if I go back to prior to March of 2020, where you might have been able to sell a business for £10 million, if this is a lifetime allowance, but if you had your £10 million worth of entrepreneurs relief available, a lot of businesses are being sold for less than that amount. And so if you're mum or dad, for example, in this particular example, if the business is being sold for less than 10 million, then perhaps there was no desperate need to look to involve the family. Certainly from a capital gains tax planning perspective, you didn't complicate matters and you could own all the shares directly. In a scenario where capital gains tax rates are higher, or the business asset disposal relief allowance of £1 million is kept, but is only £1 million, then might it be possible by including your wider family to have £1 million per shareholder, for example? Of course, the implication of doing that is when it's sold, the proceeds are then paid not to you but to those family members. Someone's got to think very carefully about whether that is what you'd like to happen. But in principle, that's something we may see more of going forward. And of course, in circumstances where we would like it, maybe we'd have a holding company own the trading company, because of course, once that's sold, the holding company really becomes our family investment company going forward. And in this scenario, we've got 5 people participating, but it doesn't mean that we've got 20% each. Those percentages can be different, and actually the rights to the shares can be different as well. But again, that might create a conversation really around estate planning and how we want that value to sit from an estate planning perspective as well. But again, might we see more structures of that nature if CGT rates are on the increase? So in circumstances where business asset disposal relief goes, we're already seeing more of these sort of structures as it stands with CGT at 20%. If CGT rates go very high, relatively speaking, 30% or 40%, and perhaps there is no business asset disposal relief, no 10% rate, it really does change a lot of the conventions. Might we see, for example, more trade and asset sales? So at the moment, the main rate of corporation tax is 19%. Now, yes, of course, that's something that may also change, but in that scenario, may we see more asset sales of businesses rather than the sales of shares as we've seen them in the past. Something that's not very well known are employee ownership trusts. We've had a few clients sell their businesses to employee ownership trusts. Very typically that's been because they've got a particular set of circumstances in their life that means that they either don't need to benefit or want to benefit from it, and they want to pass that on directly to their staff. And an employee ownership trust can own the business, and it operates really for the benefit of the employees. Now, if CGT rates go very, very high, are more people inclined to consider that as an option? Might we see more structures that take advantage of the enterprise investment scheme, or will we see a different convention as far as our approach to pensions is concerned? And I've got a couple of slides on EIS and pensions. Now, there's a story to this particular structure. I've got a client who invested money into a company under the enterprise investment scheme along with a bunch of other individuals, and he got in contact to say that the business hadn't panned out as they intended, and is that something we can just help close down? And the business in this instance had run for 3 years, and what you get if you invest under the enterprise investment scheme and you meet the conditions for 3 years is that the shares that you invest in carry a CGT exemption. Now, in a scenario where capital gains tax rates are high and we've moved up from 10% to something else, that's a highly valuable relief that we shouldn't necessarily throw in the bin by getting the company struck off. And so what we spoke about in this particular instance was, can we, via reductions in share capital, purchase of shares of some kind, get rid of the other shareholders, with their consent, of course, on the basis that my clients will then have the same number of shares, but they will represent 100% of a business which is no longer being carried on. In that scenario, what we have is a 100% owned company that's dormant, but with shares that carry a very valuable CGT exemption. And then might we see, and you can see B1 and B2 and B3, subsidiaries that might be set up for each of the entrepreneurs' new businesses going forward, whatever the nature of those businesses might be. So certainly the creative entrepreneur will ask the question, well, David, can we set up a very small business under EIS, run it for 3 years, and then adopt that strategy? I think that that's clearly pushing at the envelope in terms of what HMRC would consider acceptable. But certainly if there's anybody who's a serial entrepreneur who's made some EIS investments where the operations of the business haven't panned out as intended, I wouldn't be very quick to sort of write that off and get it struck off. Is there some use for that business going forward, in particular the CGT exemption? Now, pensions, in a scenario where you're selling your business and paying 10% capital gains tax, it's very attractive, isn't it, just to receive those funds directly. It's very common, and a lot of the sales that we have seen, if there are excess reserves in the business, reserves beyond what's required for the working capital, but it's been a convention for some time that the purchaser would add that value to the sale proceeds, in effect allowing you to withdraw the money at entrepreneurs' relief rates as it was at 10%. In circumstances where CGT goes higher, and we're already seeing this now, does that possibly change the convention on what we do in that scenario? Might we be more inclined not to receive a greater level of proceeds, but actually for the company, in this example, to make pension contributions for the directors, shareholders and owners? So you can just see there that the cost of those, the net cost to the company of those contributions, and what that could mean for your pension, means that it's more attractive with where CGT rates go a lot higher. So will we see more of that going forward? So that's really the purpose of that is just to highlight will structures need to change as a result of CGT changes. So just to finish up then, we've just got a few items around COVID, and I think it's important to say that some of these actions aren't specifically COVID-19 related. Actually, they're relevant in any cases where we've got a downturn in economic performance of a business, or actually whether we've got, you know, ups and downs for over a particular period. And there's certainly been a lot of that over the last, you know, 7-8 months, I would say. So these are just really some points that have worked out well, tips that have worked out well for our clients over the last few months. So the first one is asset protection. If we've got a successful trading business with assets, for example, a trading premises or excess cash, but we're entering a period of uncertainty, is the appropriate action to look to ring fence some of those assets in a holding company. Now we've got to take advice. We can't, you know, we've got to comply with the Companies Act, and we might need some advice from some insolvency practitioners to make sure we go about these things in the right way at the right time. But in principle, you know, there's something there that should be considered by businesses that have a lot of assets that might have, you know, some uncertainty in their near future. That's certainly something our clients have been looking at in recent months. Changes of accounting period. This is something that just seems to be overlooked by a lot of people very often. I spoke to a client the other day who said that in the year to the 31st of March 2020, and this is the example actually on the right hand side, you know, they'd actually sold a piece of land that they were developing right at the end of the accounting period, and now they're in difficulty because of, you know, they've got some tax bills to find. And is there anything that we could do about it? And actually, rather than look at the accounting policies and what you could do with valuations around stock and things like that, actually, can we simply just change our accounting period and actually drive a much different, you know, a very different profile in terms of our tax payments going forward? You know, on the left-hand side, we've got a business that, you know, over let's say, well, a 12-month period between start and end, we've got profit period and loss period and profit period. You know, how do we optimize our tax flows? You know, if we change our accounting period, you know, for the first or the second green line. So, you know, just something to bear in mind. Your accounting period, in a lot of cases, can be changed, and that can change your tax payment profile. So, something just to be aware of. And the last thing we've been doing quite a bit of over the last few months is share rewards. So, you know, employees who've been working hard, you know, trying to keep the business going, how do we reward them in circumstances where maybe there's not a lot of cash to pay bonuses, for example, and actually providing them with shares is a non-cash benefit. It's possible that during COVID, is there a better argument that there is a low valuation for those shares? The individual might well pay income tax on the value of those shares, and are we in a period of time now where the value of those shares can be argued to be lower, certainly perhaps than it was at the start of the year, or possibly even next year? So, you know, is now the time to think about our share reward structure? Certainly, if that's something that, you know, has been on planned, you know, in the next year or so, can we strike while the iron's hot now to get a better outcome? Certainly, options are preferred in a lot of cases, and very often there's no tax upfront for options. So with shares and options, is there a mechanism there of providing some feel-good factor, some rewards for some employees without a particular cash outlay? And if you do have any existing share arrangements, you know, do we need to review those in light of what's happened over the last 12 months, in terms of making sure that people are still incentivized, you know, to do what you'd like them to do in the business? So that's it from me. So it points to remember, you know, does structure need to change in light of CGT changes that have happened in the past or are anticipated in the future? And you know, there are some steps that you can take related to COVID to help improve the tax cash flows of the business that aren't related to some of the government support that you might also be benefiting from as well. Thank you.
Thanks very much, David, and thanks to all the other speakers for today's session. Thanks to Catherine and thanks to Bruce. Their details are up on the screen. You can see them all there. If you do have particular questions that you want to ask any of the speakers today, then by all means do get in touch. They'll be more than happy to have a conversation with you. Their details are there on the screen. The recording will be available on our website as well, so please do check that out. Okay, that's all from us today. We hope you've enjoyed the webinar, and see you again soon. Thanks very much. Bye.